Good afternoon, everyone. Welcome to today's session of the GFLEC Federal Reserve Board Financial Literacy Seminar Series. But before we begin with today's seminar, please be sure that you are all muted and your videos off for the time being. If you have questions during the seminar, please submit them through the Q&A box, not the chat box, and I will bring them to our speakers' attention. Again, questions via the Q&A box. So it is my great pleasure to introduce today's speaker, Dr. Vicki Bogan, who is an associate professor in the S.C. Johnson College of Business at Cornell University. Dr. Bogan is the founder and director of Cornell University's Institute for Behavioral and Household Finance, and she is a founding editor of the academic journal Financial Planning Review. Her research interests are in the areas of financial economics, household finance, behavioral finance, and applied microeconomics, centering on issues involving investment decision-making behavior and financial markets. Dr. Bogan's research has been published in leading econ and finance journals. She has testified before Congress, and she has received multiple awards for excellence in teaching. Today, she will be talking to us about her work on fear and investment risk-taking. So without further ado, please join me in welcoming Dr. Vicki Bogan to our seminar series.
Thank you so much for such a gracious introduction, Joanne. Thank you for allowing me to be here and present at the seminar. I'm really excited to present. And so let me kick off by sharing my screen and letting you, let's see. Can everybody see my screen?
Yes, thank you.
And opening up the presentation. So I'm going to eventually get to the paper, but I thought it might be helpful to just give a context of my research so you can understand where the paper that I'm going to talk about fits in my overall research agenda. Most of my research focuses on household investment decision-making behavior, really understanding that people do not make financial decisions in the way that most theoretical finance models say they should do. And so I spend a lot of time looking at factors like market frictions, behavioral biases, and household structure issues that actually influence the financial decision-making process of households that we may need to incorporate in models. Most recently, I have focused a large part of my research agenda on the relationship between financial decisions and mental health. And so why have I done this? It's because mental health actually is quite a prevalent condition in the US. The latest statistics from the National Institute of Mental Health report that almost 1/4 of the US adult population experiences some type of mental health issue. According to the CDC, we know that COVID-19 has actually increased the prevalence of mental health issues related to the population. And so I've spent a lot of time recently looking at the connection between mental health and well-being and household finances and financial decision-making. And so along those lines, I've looked at questions related to retirement savings and mental health, related to portfolio allocation and household financial decisions when they have a child with a special needs child or a child with a mental disability. I've looked at portfolio allocation and mental health issues in general for households. And I've also looked at the effect of veterans experiencing trauma and how that affects their portfolio allocations. And so that last paper looking at the effect of trauma and portfolio allocation is really one of the papers that's kind of led me down a path that has led me to this particular paper that I'm going to talk about today. And the title of the paper is Fear and Risk, Do Visceral Factors Affect Risk-Taking? And this is joint work with my colleague at Cornell and co-author Scott Yonker. And so I'm very delighted to talk about this paper. This is a relatively new working paper, and so I very much would appreciate any feedback, comments, or questions that you can put in the Q&A portion of the webinar. It would be much appreciated. So let me kick off, in terms of the talk, I'm going to kind of do the standard, talk a little bit about where this research fits in the context of the literature, focusing on our primary research questions. I'll try to preview the findings first in the case I don't get to the end, and then talk about our identification strategy, which is actually critical for this piece of research, and then talk about the data, the empirical analysis, and then I have some concluding remarks. So in terms of the motivation for the paper, it really stems from the idea that rational agent models don't explain many of the key features of financial markets that we observe. And so there's some established puzzles in the finance literature where, markets and people don't behave in the way that the models actually predict. Some of these puzzles are things like high volatility in asset prices that we observe, the large equity premium that we observe, the counter-cyclical nature of expected risk premium. Those are all puzzles that we identified and have been well established in the literature. And one of the kind of potential keys that has been identified to some of these puzzles has been the idea of systematic time-varying risk preferences. And there are some theoretical models that feature kind of time-varying risk preferences, and they've been identified as a way to explain some of these puzzles that I previously mentioned. And so in terms of the motivation of this work, it's really trying to understand factors that influence, financial decision-making broadly, but also we want to provide some compelling, direct, real-world empirical evidence as to why that could support some of these theoretical models that you see on listed there. Within the recent literature, we know that there have been several papers that have documented evidence consistent with countercyclical risk taking. So I'll just point to the Guioso et al. Paper that looks at evidence after the 2008 financial crisis. They look at both quantitative and qualitative measures of risk aversion, and they find that risk aversion increased for individuals after the financial crisis, and these affected individuals divested from risky assets or equities. We also have, I'll mention the Necker and Ziegelmeyer paper that also studied the 2008 crisis using German data and found that households that attributed losses to the crisis actually decreased risk tolerance and planned risk taking. And so we're starting to see empirical papers that show decreased risk taking because of, fear or trauma or emotional factors. But despite this suggestive evidence, the specific channel causing investors to reduce risk has been difficult to identify. One promising channel put forth to explain some of the empirical research that I just described is this idea that negative emotions or visceral factors could provide some clues to this empirical evidence that I was just describing. And so this idea comes from kind of Lowenstein, who models that utility actually can be modeled as state dependent on negative emotions or visceral factors. And so we wanted to kind of explore this potential channel of visceral factors and how it could influence investment decisions by individuals. And so when we consider if, negative factors are an influence on risk taking, there is some literature that's related to kind of this big question in this line of inquiry. We have the Cohn et al. Paper. It's an AER paper that uses an experimental setting to prime investors with like market busts and market booms and see how it affects their risk-taking behavior. And they find that those primed with a market bust actually take less risk. And then in surveys of these participants, those participants also report greater fear. And so they begin to start to link fear in investors to decreased risk taking. The other paper, the Guioso et al. Paper, actually tries to induce fear in subjects by showing them clips from horror movies. And they demonstrate that subjects that are shown the horror films and experience fear report higher levels of risk aversion. So in the literature, we have kind of a group of experimental papers that are trying to begin to make this link between fear and risk taking. We also have in the literature a group of papers that provide some indirect evidence of how visceral factors or negative emotions affect investment decision-making. And these papers try to indirectly link investor emotional states with risk-taking by documenting that investor moods and emotions are related to stock market fluctuations. And so to give you an example of that, there's the Edmonds et al. Paper that's listed there that shows that country-level stock indices are lower days after the country's national soccer team is eliminated from the World Cup. There are a couple of papers by Kempstra et al. That look at, show that stock indices have lower returns after situations where there's reduced daylight during the day and they have seasonal affect disorder, and show that stock indices are lower on days when people get less sleep. And so we have experimental evidence trying to link fear with lower investor risk taking. There's indirect evidence showing that investor moods and emotions are related to stock market fluctuations. And then there's a strand of literature that looks at survey-based studies and found that negative exogenous shocks lead to more conservative risk attitudes. And so they look at negative shocks like natural disasters or war or violence, and they find that there's a relationship between negative shocks, experiencing a negative shock as an investor, and more conservative risk attitudes. Now, many of these studies are based in developing economies, and they use lottery type games to measure risk aversion. So the critics of this strand of literature, and I'm actually not a critic of this literature at all, but they push back and said that these measures are perhaps not well suited for developed economies, or they can often question the external validity of these studies. And so that I tried by kind of describing the landscape of the literature to set the stage for our primary research question, which is trying to look and see if fear affects risk-taking of actual investors in actual markets, and try to understand a little more about the dynamics of these effects. And so in that sense, there's some challenges to doing this, right? When we're trying to link fear with investor decisions and risk-taking, it's difficult to try to identify a relatively homogeneous group of investors where you can conduct analysis and try to eliminate confounding factors. And so that's one big hurdle in trying to answer this question. The other hurdle in trying to answer that question is really trying to identify a randomly assigned treatment that generates fear in the real world, but is unrelated to personal, local, or macroeconomic factors that could also affect risk-taking decisions. And so in the previous literature, looking at issues of, a financial crisis or some kind of macroeconomic factor that can cause fear, but also affects wealth, which could influence investor behavior, is not the cleanest identification strategy. So what we're trying to do is make a contribution and improve on the literature by using an identification strategy where we have a randomly assigned treatment and a relatively homogeneous group of investors to try to make this connection between fear and risk taking. And so in our context, what we try to do is analyze the effect of mass shootings on risk-taking decisions of U.S. domestic equity mutual fund managers. And so just to give you a preview of the findings in case I don't get to get through everything, is that we are able to document some robust evidence that is consistent with fear-inducing temporary reductions in financial risk-taking. We find that, one, relative to non-exposed peers, professional fund managers exposed to a mass shooting event reduce risk following the mass shooting. We find that the reduction of risk is through reductions in systematic risk as opposed to idiosyncratic risk, and I'll be more explicit about that later. We find that the magnitude of the effect is stronger for mass shooting events with greater fatalities, with funds located closer to the shootings, and with funds run by managers that are more susceptible to fear of mass shootings. So the magnitude is stronger when the fear could potentially be stronger. And we also find that our results are robust to alternative risk measures, to alternative controls and control groups, to alternative event horizons used, and to alternative sources of mass shooting data. And so we try to do a series of robustness checks that make sure that our results are consistent when we challenge some of the assumptions we make in our empirical analysis. The other big point that I want to make in terms of some of our key findings is that the risk reduction that we find is temporary. It lasts about 1 quarter. So it's 1 quarter or 60 trading days following a mass shooting. And I highlight that because the implications for a temporary versus a permanent effect are different. A temporary effect actually will induce greater volatility in markets and lead to a more reasonable potential explanation for some of the puzzles that I mentioned at the beginning of the presentation. And so in terms of our intended contribution and what we would like to do with this research is to try to document statistically and economically significant evidence that's consistent with fear-inducing temporary reductions in financial risk-taking. We want to provide the first direct empirical evidence that visceral factors affect risk-taking in actual markets. As I said before, there's literature that looks at this question in the context of experimental markets, experimental economics. There is indirect evidence linking investor mood to stock market fluctuations, but we're really trying to provide some direct empirical evidence that visceral factors affect risk-taking in actual markets. And we hope to provide suggestive evidence that systematic changes in investors' emotional states could actually exacerbate countercyclical changes in risk-taking. And that can be important if we combine the effect that we document with findings, other findings in the literature. And so that's really kind of our main goal, and in terms of what we want to contribute with this research, and wanted to give you a flavor of some of the findings up front. And so I'm telling you that our identification strategy hinges on using mass shootings basically as a proxy for fear. And why did we use this as our identification strategy? Well, we use mass shootings as a proxy for fear to test this question because there is a rich and substantial literature in psychology, in psychiatry, and also in criminology that indicates that mass shootings actually induce fear in both individuals and communities. The other reason we use mass shootings as our fear proxy is, unfortunately, mass shootings are not infrequent in the US. And in the time period that we're going to study, there were 254 mass shooting events in the US from the first quarter of 1999 till the second quarter, at the end of the second quarter in 2016. Mass shootings, by definition, are random. By definition, mass shootings are unrelated to gangs, drugs, and organized crimes. And they often occur in areas with low crime rates and no prior history of violence. So we feel that that's a pretty good evidence that we can use this as a proxy for a random treatment. Mass shootings are unconstrained by geography. So in our sample, 39 of the US states had at least one event during mass shooting event during our sample period. And also what's really key is that there's limited concern of a correlation between mass shooting locations and risk preferences of individuals who locate in specific areas. And so if I could just unpack that for a second, often in some literature, they've used exposure to earthquakes or hurricanes as a proxy for fear. But you could push back and say, well, there could be something about people that want to live in California, which has a lot of earthquakes, that is also correlated with, their risk preferences. And so there's not, given the geographic dispersion of mass shootings across the US, we have little concern about this correlation between mass shooting locations and the risk preferences of individuals who locate in areas that, are in specific areas. And so the other issue that supports our choice of mass shootings as a proxy for fear is that they're uncorrelated with macroeconomic or local economic conditions. And so based on that, we want to use, and we feel pretty confident in using mass shootings as a proxy for fear. And the next part of our analysis is that we look at the investment decisions of mutual fund managers that are exposed to mass shootings. We use mutual fund managers because their risk-taking decisions are observable and measurable over long periods of time. With fund managers, there's less heterogeneity in backgrounds, in their financial literacy, in their skill sets. And generally with mutual funds, they're clearly stated investment objectives and styles. And so we can control for a lot of potentially confounding factors that you would have with, household investment decisions, although in the future, I would like to look at that question as well. The other issue is that fund managers have been shown to exhibit fewer behavioral biases. And then you could say, well, given that they're clearly stated investment objectives and styles, and they don't exhibit behavioral biases, why do you think that there would be any connection between mutual fund managers exposed to a mass shooting and changes in how they manage their portfolio? Well, we think there could be, or we thought there could be, because there's evidence that suggests that fund managers actually imprint their own preferences on portfolios. And there's a rich literature that shows that managers do this. And their preferences range from fund managers being influenced by their career concerns. Chevalier and Ellison have a couple papers talking about that. Changes in personal wealth of a fund manager has been shown to change how they manage their portfolio. That's the Poole et al. 2019 paper. There are papers that document that family deaths, political ideology, neighboring managers, and catastrophic weather all have been shown to influence the way the mutual fund managers manage their portfolios. So we were cautiously optimistic that we could potentially find some effect of mutual fund managers' preferences on and an effect on the portfolio, the management of the portfolio. And so that's why we selected this context as our initial entryway into how to attack this question. In terms of the data sources that we use for the paper, we use mutual fund data from CRISP and Morningstar Direct. We use mass shooting data from the Stanford has a mass shooting in America database. That's our primary source. It was developed at the Stanford Geospatial Center at Stanford University. These are mass shootings that are defined as having at least 3 victims that are unrelated to gangs, drugs, or organized crime. And the database includes dates, number of victims, deaths, location type, etc. We do quite a few robustness checks. One of the robustness checks is with our data source. There's also another mass shooting data source called the Mother Jones Mass Shooting Database. We use it for robustness checks. We don't use it for our main analysis because it covers fewer events than the Stanford database. And then we use other data sources to get zip code distances, et cetera. That'll become more apparent as I go on with the presentation. And so in terms of how we constructed our sample that we analyzed, we kind of identified the sample of mass shooting events. We identified the mutual funds that would be candidates for evaluation. We identified kind of the treated and controlled mutual funds. And then we pooled the events to ensure that there was no cross-contamination. In terms of identifying the sample of events, again, the sample period is from first quarter of 1999. That's when the daily return data was available in CRISP. And then it ends in the end of the second quarter in 2016, and we ended there because the Stanford mass shooting database was discontinued in July of 2016. There are 254 total events during that time frame. To be included, we needed to have at least one mutual fund manager within 100 miles of the event location. We calculated that using distances between the zip code of the event and the zip code of the manager, and that caused us to reduce our sample to 210 sample events. Just so you know what kind of events we're talking about, I just have a list of the kind of 10 deadliest mass shootings, and these are ones that are, have gotten a lot of them have gotten quite a bit of media press. So they're mass shootings like the Orlando nightclub massacre, Virginia Tech, Sandy Hook, Columbine. So these are the types of mass shootings to give you a flavor for the ones that are included in the database. Just to give you a sense of the geographic dispersion of the mass shootings are not geographically constrained. There's at least one in 39 of the states during our sample period. This map shows you the mass shootings, and actually the size of the circles indicate the severity of the shooting by the number of fatalities. The events that are above the median number of fatalities, which is over 3, are in black, and any of the other events are in gray on this picture. If you want to look at kind of mass shootings by year over time during the course of our sample, we definitely see a general uptick in the number of mass shootings. We have classified mass shootings as high fatality and low fatality events. A high fatality event is an event where the mass shooting has above the median number of fatalities, which is above 3. And a low fatality events are events where it's a mass shooting, but they have below the median number of fatalities, which is below 3. Also, just wanted to give you a better picture of the data in terms of looking at the mass shootings by location type. Often when we think of mass shootings, the first ones that come to mind are like the Miami nightclub shooting or Virginia Tech or Columbine or Sandy Hook. So you might think of them in areas of, schools or universities, but the majority of the mass shootings are in residential areas in our sample. The other thing, I won't spend a lot of time on this slide, but I just wanted to give you a sense of kind of how we constructed and identified the mutual funds that were included in the sample. For the most part, we wanted to identify actively managed funds for our sample. So that was really the main goal for our exclusion restrictions. And we end up with an average of 1,575 funds that we analyzed per quarter. In terms of the analysis, when we're thinking about the mutual funds from that candidate sample of mutual funds, we choose all funds during the quarter of the mass shooting event. We calculate the distance between the event and the fund advisor's location. We categorize funds within 100 miles as treated funds. We also have other analysis where we categorize funds within 50 miles as treated funds. And we categorize all other funds as control funds. We pool all of the events. We drop all control funds in categories. So, anything about mutual funds, they're generally classified by style, whether it's a value fund or a growth fund or a core fund. And they're also categorized by fund size, large cap, mid cap. We drop all the funds in style categories without at least one treated fund. We drop all funds from the control group that are in the treatment group of another event during the same quarter, just so we don't get any cross-contamination. And I just want to emphasize that we have, 210 mass shooting events and over 146,000 fund event observations. In terms of the summary statistics for the sample, I did want to highlight just a couple of things. One is that the average market beta or risk for the funds is about 1, which was comforting to us, and that the incidence of treatment within our sample for treated being within 100 miles, it's about 5% of the sample, and treated being within 50 miles is about 2.6% of our sample. And so just to make sure that I'm on time, just to want to talk a little bit about the methodology of the paper. Again, we're trying to understand how fear, and our proxy for fear is exposure to a mass shooting, and exposure is, within 100 miles or within 50 miles of this mass shooting, how it affects risk-taking in decisions for mutual fund managers. And for our main risk measure, and we have some robustness checks, but our main risk measure for this is going to be total risk. And how we calculate total risk is realized total daily volatility as measured by the standard deviation of daily excess returns. Okay, and so that's going to be our measure of risk, and we're trying to look at the connection between exposure of the fund manager to the change in risk taking of fund I in style category S over the event period, right? And we look at kind of the pre-period event is 30 days before, and the post-period event is 30 days after the mass shooting event. And so beta in this equation is going to be measure the average treatment effect of fear on fund risk taking. Obviously, our regression is going to have some control variables. We're going to control for event fixed effects, and we're going to control for have a vector of lagged fund level control variables. And the treatment effect is estimated relative to funds in the same style category over the same period of time. For the analysis, we're going to cluster our standard errors by event and advisor zip code. And so what we find, and so these are our main results, is that when we start out and estimate our model within the full sample of data, we really don't find any significant evidence of a link between fear and risk taking for either treated funds that are within 100 miles or defining treated funds as being within 50 miles. But when we bifurcate the sample by high fatality and low fatality events, and so the high fatality ones are events, mass shootings, where it's above the median number of fatalities. The ones that you would imagine would induce more fear in individuals. That when we look at the high fatality events, we see this connection between being exposed to a high fatality event and reduction of risk taking for these fund managers. And so we find a strong effect for the high fatality event sample. And so being within 100 miles of a high fatality event causes a decrease in total risk taking by 4.4% or 40 basis points. And being within 50 miles of a high fatality event causes a decrease in total risk taking for a fund manager of 60 basis points. And so, you can say, well, you're just measuring total risk taking. What, can we look at specific, how are they decreasing their risk taking? And so as a next step, we actually decompose our risk measure, and we decompose it into kind of systematic risk. And so that's the estimate of market betas by regressing daily excess fund returns on daily excess market returns. So we look at systematic risk, market beta, and then we look at idiosyncratic risk, which we define as the standard deviation of residual terms from our systematic risk regressions. And so when we decompose our total risk measure in terms of systematic risk and total risk, we find, and this is showing treated funds, so within 50 miles of a mass shooting event, we find that the fund managers decrease systematic risk by 60 basis points, which in terms of, to give you a sense of the economic magnitude, that is 5% of the standard deviation of changes in market beta. So it's a non-trivial reduction in systematic risk from the mutual fund managers. We find that there's no reduction in idiosyncratic risk. And then we also check the last column, column 3, looks at tracking error. And basically that's where we test whether, fear is just pushing fund managers to kind of herd towards the market. And we find no evidence that fear is pushing managers to herd towards the market. Another step that we take to try to unpack the effect of kind of proximity to a mass shooting on risk-taking behavior is we look more at a more fine level at distance to a mass shooting. And so we do this in a couple of ways. And so in columns 1 and 3, column 1 is where we're looking at total risk. Column 3 is where we're looking at systematic risk. We, look at kind of the mass of funds that are within 100 miles of a mass shooting event, and we decompose that into quartiles. And so we take that mass of funds that are within 100 miles, and we say, okay, the first quartile ends up being funds that are within 11 miles. The second quartile are funds that are within 43 miles. The third quartile are funds that are within 80 miles. And we try to look and see, how much does, proximity or distance to the mass shooting matter? And we find, again, consistent results that show that fund managers that are closer in proximity to the site of the mass shooting, consistent with inducing greater fear, are more likely to decrease both total risk and through the decrease in systematic risk. As another exercise, what we do is we use a continuous measure of proximity to a mass shooting, and those are the analyses that we have in columns 2 and columns 4. And we show here, if you look at the coefficient on the interaction term, since a greater distance equals kind of less exposure, the positive coefficient is consistent with people that are more exposed being more likely to reduce risk. And so I know I'm a little bit short on time, but another thing that I do want to mention in terms of our analysis is, up to this point, we've only focused on using measures of realized risk and that effect on in the effect of mass shootings on realized risk. We also look at holdings-based measures to investigate how funds reduce systematic risk. So do they change the holdings based on market data, or are they just changing the portfolio weights allocated to equities? And so do they, reallocate to more cash? And what we find is that the reduction in risk by the fund managers are moving to less systematically risky stocks, not by moving more into cash. The other thing that I mentioned before is that this reduction in risk that we find is temporary. It lasts about 60 trading days, which is about 1 quarter in terms of time frame. And then another thing that I really want to point out is that the literature on mass shootings, kind of the psychology, the psychiatry, the criminology literature on mass shootings, shows that the fear effects from a mass shooting are stronger for females, and they're stronger for young individuals. And so what we test in these set of regressions here is whether the effect of mass shootings is stronger for female managers or is less strong for older managers or more experienced managers. And we actually find exactly that. If you look at columns 1 and 4, and so column 1 is our measure of total risk, column 4 is our measure of systematic risk, we find that female managers tend to reduce total risk more when exposed to a mass shooting. We also find in columns 2 and 5 for total risk and systematic risk respectively that more experienced managers do not reduce risk after being exposed to a mass shooting, and more older managers also do not reduce risk after a mass shooting. So we find that more experienced managers and older managers actually increase risk after being exposed to a mass shooting. So that is consistent with the literature on mass shootings that say that fear is greater in certain populations, and our results actually line up with that. I won't have time to go through all of the myriad robustness checks that we do in this paper, but I will just point out that we try to do things like check the validity of our randomness assumption by doing a couple of balance tests of kind of fund characteristics and demographic characteristics of the advisors for treated and untreated types of funds. We also check the sensitivity of our results to our choices of the risk measures that we use, the controls that we use, the control groups that we have, the event horizons that we study, the data set that we use. I mentioned we also do all of our analysis using the Mother Jones database as well. We check the sensitivity of our results to fund styles. We also perform some placebo tests and tests of alternative mechanisms for risk reduction, and find consistent results. So I think I've been given the signal. So I will kind of wrap up by just summarizing that we're really trying to document a causal effect of fear on risk-taking in the context, the context that we use are mutual fund managers. We find this effect that's consistent with laboratory findings. We find that the effect is actually temporary, consistent with utility being represented as state dependent on visceral factors. And, I think this research, to me, it's exciting because, one, combined with evidence that market downturns actually induce fear, it has the potential to potentially help explain several empirical finance puzzles, but also, to me, most of my literature is in the household finance area. It gives us some clues about thinking about other factors that could potentially affect household decision making and portfolio allocation. So I think I'm about 30 seconds over, so I apologize, Joanne, but I'll stop here and open it up for any questions.
Thank you so much, Vicki. What a fascinating paper and a fascinating presentation. So we have a few questions for you. So first of all, you've talked about how the results are temporary, but is this temporary reduction in risk, does this influence the long run or medium run performance of the fund, or does it really just completely disappear without affecting the performance?
Yeah, what we found so far is because it's temporary, only lasts about a quarter, and then they go back, that it, in terms of the performance of the fund, we don't find any statistically significant long run effects. But it could help explain some of the volatility of the market that we observe. And so that's where we're really trying to make a link. But that's an excellent question.
And next, are you able to separate a fund manager's post-event risk reduction? Can you separate that between the manager's personal feeling of fear and the manager's rational expectation that other buyers might pull back following an event like this, especially when it's broadcast or has a lot of news coverage, broadcasting significant uncertainty?
Okay, so actually, I think I might have a couple of a slide that will, I think, answer the question that's being asked. And so what the question is it that the manager is fearful, or maybe the manager is kind of rationally responding to something like fund flows? And so could it be the case that fund flows are related to mass shootings? And so they think mass shootings cause a reduce in flows to the mutual fund, and as a result, they're adjusting based on that. And so managers are reducing risk in response to an expected decrease in fund flows. And so we actually do check that and find, well, the first thing I will say is that in general, kind of investors in mutual funds aren't generally local to the mutual fund location, but that could be the case. And we check to see if there are changes in fund flows because, after the mass shooting event, and we don't find any significant changes in fund flows. And so that is some evidence that it's not that the managers are reacting to what they think other people are doing, and other people, providing funds to the mutual fund, that they're reacting based on their fear. But this is suggestive evidence, and so that's a fair point and a fair criticism.
So you've talked a little bit about heterogeneous responses by gender and by age, consistent with heterogeneity in the fear response itself. Do you have any information about education and whether fund managers with or without MBAs, and whether higher education mitigates or exacerbates this fear response?
I think we have data on the backgrounds of the fund managers, but we haven't explored that question. And so that actually, that would be a good thing to look at. We haven't looked at it, so I can't answer that question, but heterogeneity in education would be something to explore a little bit.
Yeah. So another question, do we know anything about whether or not mass shootings are at all correlated with macro financial or labor market shocks in a way that might confound identification in your setting?
So that we did try to look at very carefully to see in the data set, and we didn't find that the mass shootings were correlated to, macroeconomic, any kind of local conditions. And so that's why we felt pretty confident that it was a good proxy for a random shock that we could use as a proxy.
Great. And also along the lines of the chart that you showed us showing the huge ramp up in the number of shootings in recent years, is there any evidence of desensitization or heterogeneity in responses over time, given that time trend?
So yeah, I can't get back to it quickly, but we see, for high fatality events, it's goes up, but not as much as for the low fatality events. I'm not sure if we have any literature on kind of desensitization, if people are more desensitized to mass shootings. But I don't know if that is as big a concern with our analysis, because all of our action is in the high fatality events, and there isn't as significant like this ginormous ramp up that you see with the low fatality events. And so what we're observing is our statistically significant effects are in those low fatality, or in the high fatality events, which have only, had a more general increase in number.
So is there a possibility that potential home bias among investors in funds could potentially affect fund flows as well as fund managers' perceptions of client-based risk appetite?
Okay, so home bias related to the mass shooting, I think I'm not clear on the question.
I think the question might be a home bias on assets. Is that, if the question asker wants to come in and clarify, feel free to do so. Let's circle back to this question in a moment. Yeah. Have you taken your results to fund managers, and what is their take?
The short answer is no, but if you are a fund manager in the audience, please email me because I would be interested. Like I said at the start, this is a pretty new working paper. We're just, this is only the second time I've presented it. And so I would be interested in getting the kind of the take from fund managers and practitioners' perspective on our research. So I am open to any kind of conversations along that line.
I would love to learn what you learn in the course of these conversations. So you have here, something that really differs from earlier research. You have actual real world behavior, and you have this relatively homogeneous professional population to study. To what extent do you think these results might translate to retail investors as well, and household financial behavior? So, and do you think it would be larger or smaller? Or if you
okay, so I only have a hypothesis, so I haven't taken this to the data yet. But I would think that it would be larger, right? Because you have a population that isn't as one of the reasons we selected this as a starting point is we thought it would be a lower bound, because these are mutual fund managers that have a clear objective in investing, and they've been shown to have be less influenced by behavioral biases. And so because of the characteristics of this population, they're have more homogeneity in terms of their education levels also. And so I think because of the characteristics of this population, my working hypothesis would be that this is kind of the lower bound of the effect. But I'm sure really anxious to try to take this to the data and look at it in the household level, because that's a lot of the kind of work that I do.
Thank you so much, Vicki. I have to say, it was exactly the questions, I had as you were talking, also because of the evidence that you show, even among the young, actually, fund manager, and even among the women fund manager, there is such a stronger effect that we also see in the data, for example, on financial literacy and so on. And if we do find an effect on the fund manager, it would be so interesting to see this among the retail investor. And in particular, if it really stays over time or not. My expectation is it might actually stay longer. And so it might actually be interesting to very much see this effect. Well, first of all, thank you so much for being here with us and for presenting this really interesting paper. You have done so much work in showing that we need to look at all this additional feature of the data and try to take into account these emotions, these other feature that as economists sometimes we don't consider. And this is such, I think, a clever and interesting study. So thank you so much for being here today and presenting this work. And I want to also say we will continue this seminar series with another speaker. We're going to have our special address and keynote speaker in a couple of weeks on November 18, where we are going to talk about financial literacy with a special advisor of a bank on Finland, which is one of the countries which has challenged to become the most financial literate country. And so, we are going to tell them that hopefully if they do so, advisor or also investor maybe do better in their portfolio. But I think the paper of Vicki is a reminder of how important it is to consider so many factors, so many behavioral factors in our model, to take into consideration that psychology can really play a role and to enrich our models so we are better able to explain behavior. So thank you again for being here today. I know that actually some of the person who wrote the answer said that he was satisfied with your answer because you answered before. So we are also grateful to all the people that we have been listening today and also asked the questions. And we look forward to seeing all of you online for the next seminar series. And we are very happy that the seminar is recorded so the people who cannot join us can actually join us later. And I took a picture of her presentation and also the main findings so that if people just want to know the main finding, they will be able to get them in our social media in a very condensed way. Thank you. Thank you so much to everybody. Thank you, Vicki, and thank you, Joanne, and see you soon.
Thank you for having me. Appreciate it. Bye.
Bye-bye.